Hey everyone, this is Kirk here again at Option Alpha. So want to jump in here and do a video talking about assignment risk and how we can probably use an automation to mitigate that. So for my own portfolio, this is the QQQ EV bot that we built out last week and started running. It's only got two positions right now. Both positions have been absolute turds because it actually got into positions. This first position that's been into for quite some time now, like 17 days or so, got into this position before QQQ had its massive run up following the Fed commentary and all the CPI data and stuff like that. So this position is super, super deep in the money. You can tell it's in the money because the last quote is red here, which is above, means that it's actually trading above the short call strike. Actually, if you hover over it, we tell you exactly how far in the money it is. In this case, it's $21.22 in the money. So this one is not doing so good and is definitely really close to expiration. It expires this Friday on the 24th. And so what I wanted to do was build out an automation. I've been meaning to do this for quite some time with the EV portfolio, but now that we're doing it live, I wanted to build out an automation. I'm going to do it here kind of partly together with you on this video that tries to go through and judge the assignment risk of a position. And then if the assignment risk is deemed, I guess, high enough, then we would close the position potentially early than our exit options had suggested originally. And the reason that I'm doing this, just so you guys know, is because one of the things that I'm concerned about running the EV portfolio broadly is that when we were doing the testing environment, assignments don't matter, right? When you're paper trading, you can do anything you want. You can let positions run closer to expiration. But in reality, now that we're trading this for real, in a real account with real money at a real brokerage, I want to make sure that I'm trying to avoid as many possible opportunities for early assignment as I can. Now, can I avoid all of them? Of course not. Sometimes I'm just going to get assigned early, and that's going to be the case. But when you have a position like this, which is 4 days to go until expiration, it's super, super deep in the money. Our break even is a 1% chance at this point. There's really no point in holding the position any longer, right? I mean, could something crazy happen in the next 4 days? Of course. But every day that it doesn't, I run the risk that this position, which is super deep in the money, and our 368 call option is very, very far in the money, that 368 call option gets automatically assigned. Then I have to deal with the assignment. Now, granted, I'm 100% covered here because I have the long 374 call, so I'm still covered on the position, even if I was assigned. My long call option can offset that. It doesn't matter. But what matters is that it's a hassle. It's additional commissions. It's the margin headache that happens. And if a lot of these happen at the same time, then it just becomes like a compounding effect of like hassle and frustration with assignments. So what I'm trying to do here is try to avoid those and basically use automations to decide when a position is sufficiently in the money and sufficiently at the point at which it would be a high risk of assignment. So I want to show you how I'm doing that here inside of my EV bots. So again, remember all my bots share the same automations. So all I have to do is if I make one automation, I just simply add it to the other bots, which I'll do after we're done with this video. And then all the bots can share that automation as well. So here inside of my Pure EV bot, right now, again, we just have our Pure EV scanner, which is live. We've been playing around with some of the different tagging stuff, which we'll go through in another video again. A lot of people have been adding comments and questions in the community, have been sharing automations, it's been awesome. I want to do something different here this time, and I want to add an automation that is specifically a monitoring automation. Now, I started to create one called Assignment Risk Management. I also said it was for the EV portfolio, so I'm going to go into this one that I started to build out. I didn't build out the whole thing. I built out some of it, so we didn't have to do the whole thing on the video. But I built out some of it here so you can see what it looks like. So the goal of this automation, again, is to manage assignment risk. So early assignment risk, if you have a position that's deep in the money, that's one, I guess you could say, strike against the position. If you have a position deep in the money and it's getting closer to expiration, it's naturally going to be a higher assignment risk. But what will help out in determining this, because you can't determine it for certain 100%, what will help out in determining this is potentially looking at the extrinsic value of the short call strike out of any of these legs. And the reason you're going to look at that is because the extrinsic value, that's the time and volatility value left in the position. And if that extrinsic value is really, really low, then that means that there's no value in that position for the other person to hold on to, and they're better off, or it's easier for them. It's just more frictionless for them to just assign the position and convert it over. If there's a lot of extrinsic value, there's a lot of time and volatility value left in the contract, then the other person does themselves a disservice and loses essentially and forfeits that extrinsic value by signing the contract early. They're better off just to close the position by reversing the option trade. So what we're going to do is we're going to use the automation here to determine, is the position in the money? Is the position in the money at a level that would suggest that they're probably not going to turn around, and you be the judge of that on yours? And then the other thing is the extrinsic value. Is there a little bit of extrinsic value left? And if the extrinsic value is really low, then we could close the position, okay? So here's what I did inside of mine. So the first thing that I did is I'm going to repeat through every position. And so we can start to use the repeater here for the loop for each position because we just want to pull in all the positions that it has. Now, my EV bots are only going to trade short calls, short puts, put spreads, short call spreads, and iron condors. So it's only going to be short spreads. We'll just pull them all in, and then we can divide and conquer from here. In this case, what I want to do is I want to first start to divide out the type of position that it's looking at. So here I'm going to say, and you can put any decision recipe in here you want to start, but first I'll start with, is the position type a short put spread? And the reason I want to do that is because I want to use a set of decision criteria after this that are specific to short put spreads only. So in this case, I'm going to say, if yes, if the position is a short put spread, okay, great, that's the first thing. The next thing I want to check if it's a short put spread is, does the position expire in less than 5 market days? Actually, you know what? I'm going to move this around. I'm going to do this. We're going to do this now because that decision criteria we could use for all positions. So I'm just going to proceed this with a decision here. And what I did there is I just deleted it. And instead of adding it multiple times, I'm going to actually just move it up here to does the position expire in less than 5 days? That'll be kind of like a global filter for everything. So we can use that with a defined setting. So I'm going to go here to proceed with, to put a decision in front of this, go to the decisions, go down to the position expires in less than X market days. Now here you could put 5 days. You could put whatever you want. It's a very simple change. And I'm going to put yes and proceeded down the yes path. So all I did here, like I said, was I just simply moved this from being in this position here, and I moved it up to this position, which means it's going to be a global filter for everything. I'll leave the no path completely empty. So every time it's managing positions, which I don't even care, the bots don't care, automations don't care, it's going to repeat through every position. Any positions that expire in less than 5 days will continue down the regular path for evaluation, if you want to call it that. If the position doesn't expire in less than 5 days, then it goes down to the no path and it just waits until it gets closer, if it ever gets there, and that's okay. Okay, so if the position expires in less than 5 days and the position type is a short put spread, then the next thing that we want to do here is we want to have all of our evaluation. Now, this is all of the criteria that would determine for us, and I haven't made any adjustments to the captioning of this or anything, which you can and I will inside of mine, to make it a little bit easier to read. But this is all the criteria that would determine if you close the position. You're going to put it all in one automation or one decision block as a group. And notice that if all of this is true, then it goes to the yes step, which is to close the position. So if you want to close the position early and you want to judge it by assignment risk or however you want to do it, you put it all in that one single block. And that's how you tell the bot to close the position early out of its normal expiration or exit option sequence. So let's look inside here and you can see that I've got 3 different decisions that all have to be true in order for the bot to close the position early. And notice they all have to be true because I'm using the AND decision field here to group all of these decisions together. First thing that I'm doing is I'm saying the position's underlying price is below the short put strike. That makes a lot of sense, or hopefully it makes a lot of sense. We're not even going to consider closing things early. Never, 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 never. If the stock is trading above the short put strike for short put spreads, because there's no risk of assignment at that point. It's out of the money. The position is good. I don't care if it's close to expiration. It doesn't matter. We're not even going to consider it unless the underlying is trading below our short put strike. If that is true, then the next statement is the short put leg chance of being in the money greater than 70%? Now, this is where you can get subjective if you want to. What does it mean for you? Does it have to be greater than 90%? Does it have to be greater than 60%? Like, what is the current probabilities telling us that that short put leg that we have right there, that the chance of it being in the money at expiration is greater than X%? Now, again, if you want to change this, you just go into this recipe, change it to whatever you want, and you go on, right? And here you can use different values if you want to. I'm using a standard 70 because I feel like at that point, you've more than overcome, like if it's higher than 70, it's 80, 75, 80, 90% chance of being in the money. Okay, I want to go to basically decision 3. And decision 3 is really the key one here, which is we want to check the short put leg's extrinsic value. Now, this is super cool. This is like a very advanced thing to do, but once you do it inside of a bot, you can have it run forever. But I'm going to check the position's short put leg specifically, and then the extrinsic value. Notice I can check lots of other criteria for a leg, but I want to check the extrinsic value specifically, not the intrinsic value. I want to check the extrinsic value and make sure that the extrinsic value is less than a certain amount. Now here you could do whatever you want. Maybe I bump mine down to say 10 cents, right? If the extrinsic value is less than 10 cents, meaning that the total value of that leg, if the extrinsic value is less than $10, maybe somebody is more willing to assign that contract because there's just not a lot of value left in it. You could do 5 if you want. That's going to be a higher threshold to hit. So it's got to be less than 5, which means it's got to be almost 0. So that's really close to expiration. Remember, at expiration, extrinsic value goes to 0.00 because it's at expiration. There's no time or volatility value left in it. So the closer you get to 0 here, the lower you make this number, the harder it is for the bot to determine, or the harder it's going to be for the bot to say, yes, I want to close this position, or I need to close this position. If you make this number really high, like $1, it's going to lead to the bot potentially closing the position faster, as long as it's in the money and the probability is over your probability. But this is a very high hurdle rate. So you probably want to be, or I don't care where you are, but I'm probably going to be somewhere in the 10 to 15 range. I'll probably start at 10 and maybe work my way down from there. Okay. So once I have all of those, now I have the combined decision. All of these have to be true. And if all of these are true, then it will go ahead and close the position. Okay. And I can even add a memo in here, like something like early assignment removal, something like that. I can add a tag to the position saying like, hey, if this thing gets closed, it was because I like forcefully did early assignment removal, right? Something like that, or early assignment risk or something. Let's just do early assignment risk. I'm declaring, I guess, if I get to that point, that it's early assignment risk. And so that's why I remove the position. For pricing, I'm going to use mid price up to 3 cents of slippage, and I'll just try off. I just want limit orders for this one. It's probably going to be close to full price at this point for mine, so I don't care that I use smart pricing here. I want to just use limit pricing, 3 cents from the mid price if I want to. I definitely want to get this position off. I'm not trying to optimize too much here. I just want to remove the risk of the position and not have to deal with it and all the margin issues that come with it. So go ahead and put that in there and then say save. All right, so look, at this point now, I've built out essentially all of the short put spread conditions. And so what we're going to do now is we're going to build out the short call spread conditions, and then we can build out the iron condor conditions as well. And so all we're doing is basically replicating this, but swapping it for the different types of positions you have. Because remember, if it's not a short put spread, then we're going to ask it, is it a short call spread position? And if it's not a short call spread, then we're going to ask it, is the position type an iron condor? So we're going to say, is the position type, in this case, an iron condor? And you can see we're just asking a series of questions. And if yes, then we do our decisions. If no, we ask another type, okay? So here, inside of the short call spread position here, we'll just toggle this one up. We're going to add another set of group decisions. First thing that we're going to check is we're going to check that the underlying price is trading above our short call strike. Remember, we're on the short call side, so we're only checking first, is the position physically challenged? Is the stock trading above the short call strike? Okay, if yes, then we want to add another set of decision criteria. We want to see if grabbed the wrong one. We want to get some leg data. We want to see if the short call leg probability of being in the money, which is, I can't find it as I'm looking here, chance of being in the money is greater than some value, which we can say 70%. We're going to leave this as an and decision here. And then the last thing here is we're going to grab some more leg data for the short call leg, and we're going to check the extrinsic value is less than 0.10. Okay, so these all have to be true in order for us to close the position. Then if all of those are true, we're going to close the position. We're going to tag the position early assignment risk, change the pricing here. You can use whatever you want for pricing. I'll use mine limit off and 3 cents, and then go ahead and save. Now, because we actually have some call spread positions, let's go out and test this real quick. Let's just run a test on this automation. We can run it with the existing QQQ bot that we have. We're going to keep the box checked here to prevent it from actually sending the closing trade right now. We can do that when it turns on, and we're going to go ahead and start the test. Okay, so for each of these positions, the short call spreads that we have in QQQ, notice we have 2 of these, right? The first one here is the 368 call spread, 374. Does it expire in less than 5 days? Yes, remember it expires this Friday, so it does. Is it a short put spread? No. Is it a short call spread? Yes, it is a short call spread. Is the position meeting all of our criteria? In this case, it's no, and I'm actually surprised by this. You can see here that even though this is actually super surprising too, so you guys know, I did not check this beforehand, wicked surprised about this. Is the position above the short call strike? Yes, we already know that, super far. Is the short leg at a high chance of being in the money? Yes, 99.77% chance of being in the money. But is the extrinsic value less than 10 cents? And the answer is no. There's actually a decent amount of extrinsic value. And this is probably why, even though this position has been in the money for quite some time now, like over a week, it's been deep, deep, deep in the money. And why the chance of that leg being in the money is not so high either. But it's just that there's still a lot of extrinsic value. So it doesn't make any sense for somebody to assign that or exercise that long call option they have it against our short call option, because there's still some extrinsic value left in the contract. They would forfeit this value completely. So I don't know what we want to do about this one, but we can let it ride, obviously, or we can move up our extrinsic value. I did not expect that extrinsic value, truthfully, to be that high on the position. It will start to bump down. So maybe we'll just leave it here at 10, and once it starts to bump down, it'll knock the position off automatically anyway, or you could move your extrinsic value filter a little bit higher. But if that is really, there's no chance that this one's in here. What you might want to do too, and this could be just an idea, is that if the answer to this question is no, you could send yourself a notification or do some other decision criteria. Like you could do another set of group decision, like is it in the money and the probability is greater than 99%, then yes, send myself a notification to manually trade it. I'm not doing that now, but you guys could and share those automations in the community. But you can see how you can test out this logic here right inside the bot. I'll leave mine for now, and maybe there's an off chance it reverses in the next couple of days. I don't think so, but as soon as that extrinsic value starts to fall, I know this position will get ripped off anyway. Okay, the last one that we have to build out here is the iron condor. So if it is an iron condor, we're going to add a lot of group decisions in this one. This is why I wanted to build it on this video with you guys, because there's a lot of different ways you could do it. Remember, iron condors are two-sided. So you have your call spread side and your put spread side. So in this case, we're going to add lots of group decisions. So is the position underlying price above my short call strike, and we're going to add a group here. We're going to say, or is the position's underlying price below my short put strike? Okay, so same thing here. That's a group decision. Notice I just hit the gear icon, then said create a group. So that is the first grouping. The next grouping is going to be the same sets of decisions, but it's going to be in the opposite direction here, which is going to be, is the position's short call leg, is the probability of being in the money greater than 70%, and then we're going to add another set of group decisions here, or is the position's short put leg probability of being in the money, chance of being in the money, greater than 70%. Okay, so these are going to be in the money for these. Now remember, if the stock closes in between both legs, then neither of these should be true, right? Because there's no chance that if the stock closes in between your strikes and you have a perfect iron condor that works out perfectly, then neither of these should be hit. It's only when the position starts to run in one direction or another. Now we're going to switch this to an or statement, but notice in between here, we have an and statement between this group of decisions. So these collectively are one, and these collectively are one set of decisions. And between them, we have an and statement. So we're still doing the same methodology, I guess you could say, with the short call spreads. It's just that we're splitting them up for using iron condors. And then the last thing that we're going to do is we're going to check the extrinsic value of these. Now these are going to be a little bit more tricky because you have your short call legs on both sides. So you have your short call leg, and we're going to do the extrinsic value is less than, and in this case it's going to be less than 0.10. Okay, and then we're going to create another group decision, and we're going to say or the short put leg. So we'll do the short put leg, extrinsic value is less than 10 cents. Okay, and then we got those in here. So remember, we're not even going to get down here to evaluate these unless we cross these thresholds first. And if we do, then great, we get down here, we can start to evaluate the short calls and short puts on their own accord and figure out if we need to close the position. So we're going to add that big mumbo jumbo group decision in here. If the answer to that question is yes, we're going to close the position, tag the position early assignment risk, go 3 cents of slippage if we want to, and then go to off pricing, okay? And just do mid pricing on it just to get that position in there, get that order working right away to get the position off. We're not trying to optimize for anything. We just want to remove the position, okay? So that's basically the setup for this automation. Again, if you have any questions on this, please let me know. The goal here for using this, again, is just to evaluate early assignment risk and then remove positions. We're not messing with anything for our exit options. We're not resetting our exit options here. We're just purely determining if we need to remove the position or not. But once we basically get down to this criteria, it will start to remove the position, start sending orders, and making sure we get out of it, okay? So once we're good to go here, we're gonna hit save. We're gonna add this. We're gonna run this as a monitor automation because it'll run only if we have open positions. And then we simply hit save and add it to our EV bot. Now, because automations are on, this means that this will start running at the next interval, which is great. That's exactly what we want, is we want that assignment risk monitor running. It's a specialized automation just for assignment risk. And now we can go to the other bots that are running our EVs as well, and we can add that automation in. So because we already have this in our library, we're just gonna go down to our EV folder, assignment risk. We're going to run that as a monitor automation. You can see it's a shared automation inside of our portfolio. So we can just simply go to any of the bots that we're running and just add the same automation from our library since we saved it in our library. It's super, super easy to rerun this. Also now, because it's a saved automation in our library, this means that any changes that we make to it are saved across all bots. So it's not like we have to change every single one that we're running on different bots. So really easy to do. I'll add them to the rest of these bots that we're running here, but I hope this really helped out. If you do have any questions, let me know. If you thought this was helpful, give us a thumbs up, share this video, and we'll see you on the next one. Until next time, happy trading.